Hello and welcome to Sectors Up Close. I'm David Pollard. US utilities, is now the time to invest? We'll be discussing that question with our guest today, John Stoltzfus of Oppenheimer Asset Management. Take a look over 5 years and the performance of this defensive widows and orphans investment is at 21% for that whole period. Not so impressive when compared with 184% for technology stocks. But does a 19% rise in this year to date tell a new and different story? Their fans say yes, that utilities can bet on a bright future, that possible grid upgrades and a voracious appetite for energy amid a drive towards EVs, AI and sustainability all make a compelling case. Well, joining me now is Oppenheimer Asset Management Chief Investment Strategist, John Stoltzfus. John, many thanks for joining us today and welcome. Let's look at the performance first of all. Are investors simply piling into utilities at the moment as an alternative to, the very highly valued tech stocks and the rally that we've seen, which is now kind of falling apart a little bit? And have we seen the best of the surge in utilities with 18% year to date?
Well, David, I would have to say that we think there are several things that are really driving the utility sector higher this year. One is, as you very well say, investors are beginning to diversify outside of technology after going through a period where technology was not just the leading sector. We do think technology will be sharing the stage with other sectors like financials, like consumer discretionary, and utilities as the Federal Reserve moves towards cutting interest rates.
Now, you argue that the future is bright for utilities, and one part of that is sustainability and the huge new demand that you see for energy, for AI and so on. Now, how do we begin to assess the scale of that demand, and what sort of threat to sustainability could a new government, if Donald Trump were elected, could a new government pose to it?
What we believe we'll see is most certainly utilities on a broad basis benefiting as they continue to use traditional methodologies. Well, they've moved mostly away from coal, but moving more using natural gas, of course, and also beginning to utilize more alternatives, whether it's solar panels or whether it is the modern windmill, the turbines. All of that, as battery retention improves, should be more important to investors. We can't help but think that in the process of this, utilities, of course, are also benefiting from the fact that if the Fed indeed begins to reduce interest rates, once it starts cutting, what you will likely see is a reduction of the risk of being what we call a bond proxy sector, wherein when interest rates rise and bond yields go up, it hurts utilities considerably.
But in prospect is possibly a huge build out in terms of infrastructure and energy supplies. That in turn is going to require a huge amount of capital expenditure. What sort of pressure is that going to put on yields and dividends in the sector? And isn't that a rather bad prospect for investors?
Well, we can't help but think the wonderful thing about the large cap utility sector that's represented in the S&P 500 is most of those utilities are regulated utilities. And as such, as their input costs go up, they go to the regulators and request the ability to raise what they charge their customers. We've certainly seen it in New York. When I look at my utility bill, it's higher than it's ever been before, and yet I'm using less electricity than I was. I think I'm operating more efficiently. Go figure. But for the utility companies, likely a good thing and likely something that will actually keep dividends fairly well supported because their profits are likely to go up.
And if there is a huge amount of capital expenditure, are investors wise to look at possible alternatives to utilities in terms of equipment makers and independent power providers?
I think that's a terrific question, David. When we think of it, it's not just concentrate on the utilities themselves, but we think the industrial sector that makes all kinds of equipment for power generation and drill bits for finding oil or looking for opportunities in thermal power, what have you, or if it's building the equipment and the robotics and the AI that is required to run the windmills and the solar panels and the batteries, we'd have to think that industrials would be a highly complementary sector, as well as technology on a broad basis.
And what are your tips for sorting the wheat from the chaff in this very diverse sector? How do we compare a company like NextEra, which is up 31% year to date, with some of the older names in the sector like PG&E or Edison and so on? What are your tips there?
We want to look for those companies on a valuation basis relative to growth and consider the duration that is likely embedded in the pricing of these things and in their stance currently in the utility sector. So to consider, are they overvalued or undervalued? The companies that are in the forefront of the next generation of energy would likely have to be considered with a sharpened pencil right now. They've had a very good run this year. And then one would want to be looking at some of the ones that have been underperforming on a relative basis, though there's been a lot of good performance in the sector.
Okay, we'll leave it there. John Stoltzfus, Chief Investment Strategist at Oppenheimer Asset Management. Many thanks for sharing your thoughts with us today. And that is your roundup of US utilities. I'm David Pollard, and this is Reuters.